We're in the middle of a close to 40-year experiment in how leveraged can a system be and in how many ways. The global derivatives market today is something like $700 trillion notional amount, and although, of course, that doesn't exactly represent a proxy for risk, between the fact that 75% of that is interest rate derivatives and that in 5,000-ish years of history, there have never been interest rates remotely close to where we are now, causes me to think that this long downtrend in interest rates, which now have something like 30% of developed market fixed income trading at zero or weirdly below, despite the fact that it hasn't worked. And they say it has worked, and what they say about it, they meaning central bankers and those who apologize and support and cheer on central bankers, they say, well, growth hasn't really picked up, but in the absence of what we're doing, it would have been a lot worse. I don't think that's right. I think it's possibly right as far as it goes, meaning because of the lack of the obvious low-hanging fruit of fiscal, and I'll explain what I mean by fiscal policies that would restore levels of growth significantly higher than those described by Ray Dalio and Tim Geithner, restore that to the developed world. In the absence of fiscal policies in tax, regulation, trade, education, policies that would deal with the consequences of technological obsolescence. In the absence of those pro-growth policies, sure, monetary policy is the only game in town. But 8 years of ever-declining rates and ever-increasing radicalism in other monetary policies have not created a sustainable, accelerating uptick in growth. What they have done is created a tremendous increase in hidden risk, a risk that investors don't exactly know or have faced about their holdings. And I think it's a very dangerous time in the global economy and global financial markets.
And by way of reminding people as well of 2007, when, as I read in Gillian Tett's account, you and Jim Chanos sat with the finance ministers of the G7, correct? And told them of your concerns about the market at that point. And said, you know, we look at a lot of these exotic mortgage instruments and we look at what's happening and we think the banks are ultimately going to have huge problems and they're over-leveraged, and we want to warn you about what we see happening with the global financial system. And Geithner and others were in the room, as I understand, and they sort of said, okay. So even for people today who might have heard your warnings before, would you say that now we're at a point like in 2007 when that HSBC index was cracking, when you see bond markets cracking? Is now that point? Is it bad enough to warn people today like you would have wanted to warn them back in 2007?
Let me make a comment or two about that time and that episode. It wasn't just myself and Jimmy Chanos that were speaking like that, and speaking like that to policymakers and regulators. In that particular meeting, there were a number of other financial industry folks and hedge fund folks. I personally went to Germany to meet policymakers in Germany because we had some relationships in the finance ministry. And they were a little bit more receptive, but to me, the most interesting part about that episode was it was practitioners, not academics and not policymakers, that had a deeper understanding of where the financial system was in terms of risks. The second thing that struck me about that is the amazing arrogance of the policymakers. They didn't listen. They treated us as if we were ignorant children. And of course, they didn't do anything. Neither did the German policymakers, parenthetically. But after the crash, it's all been one way. The emergency action following the crash, despite the fact that central bankers, including, of course, the Fed, had no idea of the risks that were building, had no idea of the vulnerability of the financial institutions to the confluence of these risks and the consequences of the leverage, the derivatives, the structured products, the real estate boom, all in a sort of a self-reinforcing dance. They had no idea about that. And so, to me, the credibility of the Fed and the Treasury, but the Fed going forward was severely challenged. But the immediate aftermath of the crash policy was appropriate.